Welcome back to the deep dive. This is where we take the sources and questions you send us, roll up our sleeves, and really get into the weeds. Today, we've got a really interesting one. You asked about a group of services related to getting what you called a C card. We think you mean a company branded credit card. And then the really intriguing part, you asked if a specific niche service in this area, maybe combining a few things, could actually work, or maybe even be like the first of its kind. So that's our mission today. We're going to unpack how companies can issue their own branded cards, what the legal stuff and the operational challenges look like, and then we'll dive deep into this specific model you pointed out using a promissory note to back a card, maybe even tied up with credit repair. It's a fascinating area of financial tech.
It really is. What's fascinating, I think, is how these different pieces, card issuing rules, legal compliance, even something like credit repair, can actually be woven together to create something genuinely new, a new financial product. So yeah, our goal isn't just to say what they are, but really get into the how. How are they built?
Yep.
And why does it even matter for a business?
Exactly. So let's start broad. Company branded credit cards, what are we actually talking about here? It's not just like sticking your logo on a Visa, right? It sounds more involved.
Definitely more involved, yeah. Our sources point to basically three main ways companies can structure this. Think of it like levels of complexity and control. So the first option, probably the simplest, is what's called the private business credit card program. This is all in-house. The company uses its own money to extend credit, maybe to employees or members or just, select clients. Cards could be physical, could be digital, maybe only usable inside the company or with certain partners. And the key thing, any money owed is just treated like accounts receivable on their books.
Okay, so that's pretty straightforward. They're basically acting like their own mini lender for a closed group.
Exactly. Then the next level up is probably more familiar, the co-branded or white label card. This is a partnership. Your company's name, your logo, it's all over the card. But behind the scenes, there's a real bank, a licensed Visa or MasterCard issuer, doing the actual work. They handle the underwriting, deciding who gets the card and how much credit. They take on the main financial risk. And importantly, they manage all the compliance stuff.
Ah, okay. So you get the branding benefit without having to become a bank yourself.
Precisely. And then there's the third option, the most complex, becoming a full independent issuer. This is where your company is the bank, effectively. You issue the card yourself. But this means, it means full-on compliance with federal banking law, FDIC rules maybe, Truth in Lending Act. Often you need a proper bank charter or some kind of special purpose license. Maximum control, yes, but also maximum regulatory headache.
Wow, okay. That's quite a spectrum. So back to our listener's question about acquiring a C card, it really sounds like you build it. You don't just buy it off the shelf. So how does a company actually do that? What are the steps legally and practically for, say, each of those three models?
You nailed it. It's definitely about building. And the steps, they get more intense with each model. For that internal private program, legally, you need your company set up, like an LLC or corp, which you probably already have. The real legal work is drafting very clear terms, credit limits, interest, repayment schedules, and if it's for consumers, not just employees. Got to comply with things like the Truth in Lending Act. Total transparency. You might need state lending licenses if you charge interest, and you'd likely use the Uniform Commercial Code, the UCC Articles 3 and 9, to formalize the debt.
Okay, UCC. Got it. What about the co-branded route?
For co-branded, the big legal step is finding and negotiating with that partner bank or issuer. Yeah. Companies like Marqeta, Stripe Issuing, WebBank, those guys. Your lawyers are hashing out revenue sharing, who pays for what, how the branding looks, risk management, all that. But the huge plus, legally, the bank partner handles the really critical compliance, know your customer, anti-money laundering, KYC, AML. They shoulder that burden.
Right, which sounds like a massive relief.
It can be. Your company might still get a slice of the interchange fees, the small fee on each transaction, and you focus on the customer experience, the perks.
And the full issuer path. Sounds like the legal deep end.
It is. You're looking at getting a bank charter maybe, or using a bank sponsorship model where you partner very closely with an existing bank. You need to apply for a buy-in that's a bank identification number from Visa or MasterCard. It's like your card's unique address. Registering with the Consumer Financial Protection Bureau, the CFPB if you're dealing with consumers, and just maintaining rock-solid compliance with the whole raft of federal acts, TILA, ECOA, Fair Credit Billing. It's becoming a regulated entity.
Okay, that's a mountain of legal stuff. But what about just, making it work day to day, the operations? What kind of systems do you need? This is where it gets really interesting, I think.
Yeah, the operational side is crucial. No matter the model, you need some kind of card issuance and management platform. Usually this means using APIs. Those are like digital messengers from tech providers. Stripe issuing, Galileo, Marqeta, Synapse, Unit, Rails, there are quite a few now. These platforms handle creating the cards, activating them, tracking spending, managing the accounts. It's the tech backbone.
Okay, so you need the tech. What else?
You absolutely need credit scoring and risk management. How do you decide who gets a card and manage the risk they won't pay back? You could build that in-house, which is tough, or, more commonly, you partner with third-party services. Think Experian Business, folks like that. Then there's accounting. Really important to use the accrual method. That means you record income when you earn it, not just when cash comes in. Helps you track receivables, interest, potential losses accurately.
Accrual method.
Right. And finally, customer agreements. You need rock-solid, legally enforceable cardholder agreements. Regulation Z actually requires specific things here, laying out all the terms clearly.
Okay, so with all that complexity, the legal hurdles, the operational setup, why would a business even want to do this? What's the upside? What are the big strategic wins here?
That's the million-dollar question, right?
Yeah.
But the advantages can be pretty compelling, especially if you're thinking about that benefits niche service idea. First off, control. Complete control over financing terms, interest rates. You're not stuck with whatever a partner bank dictates. You can tailor it perfectly to your customers.
Okay, control makes sense.
Second, you're actually creating an asset. Those outstanding card balances. They're receivables on your books. You can sometimes bundle these up and sell them. That's securitization. It creates financial flexibility.
Interesting. Turning spending into an asset.
Exactly. Third, you can build an internal banking loop, manage chargebacks yourself, run loyalty programs seamlessly, maybe even handle internal trade finance. It keeps customers sticky, engaged within your ecosystem.
Like creating your own little financial world.
Kind of. And finally, it can seriously boost your company's valuation. Having those receivables, that interest income stream, it makes your financials look stronger to investors. It shows predictable revenue.
Okay, those are some solid reasons. And that really sets the stage perfectly for the listener's specific question about this niche service. We've seen how cards can be issued. Now, let's look at this unique idea. Backing a credit card with a customer's promissory note. They mentioned the Mexium Credit Repair and Card Access Program. So the big question is, can you actually do that? Issue a card based on a formal IOU. Is that legal?
The short answer, yes. With careful structuring, absolutely. Your proposal, or the one you're asking about, it's lawful and potentially very viable. The legal basis is the promissory note plus the credit extension. So a customer signs a legally binding promissory note, let's say for $5,000. That note, it's a legitimate, enforceable receivable, an asset on the company's books. That signed agreement then justifies issuing the credit card or line of credit. And under the accrual method of accounting, which we mentioned, it's standard practice, backed by tax code like 26 U.S.C., Section 446, Section 451. Once that promise is legally solid, you recognize the value. You book the receivable, the potential income, even before cash changes hands. The key is the note must be real, voluntarily signed. Clear terms for repayment, interest, maturity, default.
Yeah.
It can't be a fake agreement.
Right, it has to be a genuine promise to pay. So just to make sure we're all following, how does it actually work step by step for the customer and the company?
Okay, let's walk through it. Step 1. Customer signs that promissory note, say for $5,000. Step 2. Company records that note. It's now an asset, a secured promise. Step 3. Company issues its credit card, could be private label, could be co-branded with a limit tied directly to that $5,000 note. Step 4. When the customer uses the card, the amount they spend either reduces the available balance tied to the note or maybe creates a separate liability under the card agreement itself, depends on the exact terms. Step 5. Interest starts accruing, either on the card spending or maybe on the original promissory note amount, again, based on the agreement.
Okay, that flow makes sense, but what are the specific legal things to watch out for with this model? Using a promissory note seems different, less like traditional lending maybe.
It has its own nuances, definitely. Legally, you're looking at the commercial code, the UCC again. Article 3 says a promissory note is a negotiable instrument. It's a formal IOU that can even be sold or transferred. And under Article 9, you can use that note as security for the credit line. You might even file a UCC-1 financing statement that's like a public notice saying, hey, we have a claim secured by this promise.
So the UCC provides the framework. What else?
Lending laws are crucial. If you charge interest, you absolutely have to check state usury laws, the maximum interest rates allowed, and any state licensing needed for lenders. And if it's for consumers, Truth in Lending Act, Regulation Z disclosures, they all apply. Full transparency is non-negotiable. There's also a point about the banking exemption. If you structure it right, essentially acting as a lender using your own capital or funds secured by these notes, and crucially, not taking customer deposits like a regular bank does, you might avoid full FDIC bank regulation.
So not taking deposits is key.
Very key. But, and it's a big but, you still have to follow all the relevant federal and state lending laws. You're operating as a specialized lender, just not a deposit-taking bank.
Got it. And the accounting and tax side with this accrual method, how does that play out exactly?
Right, so under accrual accounting, that $5,000 promissory note, it hits your balance sheet immediately as a receivable, an asset, increases your company's assets on paper. As interest accrues on that note or the card balance, even if the customer hasn't paid it yet, you record it as earned income, boosts your revenue. And the flip side, if the customer unfortunately defaults and never pays, eventually you can usually write off that unpaid amount as a business bad debt, which can provide a tax deduction under IRC Section 166. Helps offset the loss somewhat.
Okay, theory makes sense. Now let's get concrete. Let's look at those Mexian documents you mentioned the listener provided. How does their program actually seem to implement this promissory note model in practice? Let's unpack that specific example.
All right, looking at the specifics of the Mexian credit repair and card access program documents, their promissory note sample is pretty clear. It outlines a principal amount, say $1,000 to $5,000. It specifies an annual interest rate, looks like 10 to 18%. It details repayment terms like equal monthly payments over 1 to 3 years. And critically, it has a default clause, what happens if you miss payments, and specifies which state's law governs it. Standard stuff for a solid nut.
And the card agreement itself.
The credit card terms and agreement directly links the card's credit limit to that promissory note principal. So if you sign a $2,000 note, your card limit is $2,000. It also mentions usage limits, maybe only certain merchants. It clarifies interest and fees align with the note. Importantly, it states they report performance to credit bureaus. That's the credit building piece. And it covers borrower liability and how the agreement can be terminated. All seems standard for a card agreement tied to a specific underlying obligation.
And what about the credit repair part? That seems tied in.
Yes, and they address that with a credit repair services disclosure. This looks designed for CROA compliance. That's the Credit Repair Organizations Act. It emphasizes key consumer protections. No charging fees before services are done, requires a written contract, gives a 3-day right to cancel. And crucially, it includes the required disclosure that they can't guarantee specific score increases. That's legally vital for any legit credit repair service.
Okay, so the documents seem to cover the bases. How do they actually pitch this to a customer? What's that first conversation like, according to their script?
The customer onboarding script example gives a sense. It frames it as joining Mexian's credit repair and empowerment platform, one quote. It tells customers that by participating, they may qualify for this credit access card. But to get it, they need to do the credit repair intake, sign the promissory note, and agree to the monthly payments. The script highlights that making those payments on time is how they'll build their creditworthiness. So it explicitly links the card access and usage to the credit repair journey.
Right, so it's presented as a package deal, almost. Card access is a benefit of engaging with the credit repair and making good on that promissory note.
Exactly. It's a synergistic model.
So bring this all home. For a company running a model like Mexian's, what are the big advantages of this specific structure? And based on what we've seen, is this a genuinely viable niche? Could it be pioneering, as the listener wondered?
The advantages of this specific model are pretty clear. It boosts their receivables, which helps their balance sheet and potentially offers collateral. It creates a steady stream of passive income from the interest. It builds really strong customer loyalty you're providing, both credit repair and a path to credit access. Creates that internal financing loop we talked about. And it lets them offer credit to potentially underserved customers based on a direct promise and relationship, not just a credit score, without needing huge upfront capital themselves. The note is the backing.
So viable, then. And pioneering.
Viable. Based on the structure outlined and assuming diligent compliance, yes, absolutely. The legal and accounting principles are sound. Pioneering. Well, the sources don't flat out say it's the absolute first ever, but this specific combination promissory note backing, tightly integrated with CRA-compliant credit repair and structured to potentially avoid full banking regulation while following lending laws, it's definitely a sophisticated and, I'd say, innovative approach. It really demonstrates quite clearly how a company can carve out a niche as a specialized lender. It's a clever use of existing financial and legal tools. So while maybe not the only one, it certainly feels like a well-thought-out, potentially leading-edge model in that specific niche.
Okay, so let's wrap up this deep dive. We started broad with company-branded cards, the internal kind, the co-branded partnerships, and the full-on issuer route. We dug into the legal maze and the operational tech needed for each, and then we really zoomed in on this fascinating niche model using promissory notes, tied with credit repair, using Mexian as the example.
Yeah, and I think if we connect this to the bigger picture, what it really shows is that understanding the underlying structures,
Hmm.
the legal frameworks, the accounting rules is key. It highlights how innovation happens, even in finance. You can combine existing tools in new ways to create different kinds of products and services, even in a space as regulated as lending.
Absolutely. And thank you, listener, for sending in the sources that sparked this whole discussion. It was a really interesting path to explore. And for everyone listening, here's something to think about. Now that you understand a bit more about these complex financial structures, how might that knowledge unlock new possibilities? Not just for businesses trying to innovate, but maybe for individuals looking for different ways to access financial tools or build credit. What kinds of new, maybe hybrid financial services could you imagine emerging from models like these?